Hey everyone, it's Ben here, and today we're going to be going over trading comps, which is a valuation methodology that a lot of investment bankers use and also people use to value stocks. And today's objective is to help you understand the theory and mechanics behind the trading comparable companies valuation analysis. And what we're going to do is go through Excel, and there's a link to that Excel plus the PDF for this presentation down in the description below. As you go through this, of course, you can just watch the video and see what I do. But if you do want to kind of go into the Excel as I am doing it and learn by inputting the figures yourself and doing all the calculations, I think that'd be a great way for you to learn. So feel free to download that link now and pause the video. And going over today's agenda, first, I have to go through some key accounting concepts that are really important for trading comps. And in case you're a beginner, because this is more of like a beginner's video, I wanted to go over some of those key concepts. Then I'm going to talk about what trading comps are, then go into the 5 steps, and then briefly just kind of mention what some advanced topics look like. I won't actually go into that in today's video, but probably in a future video. Before going into everything, though, I did want to let you guys know about today's sponsor, which is Wall Street Prep. And this company has been training analysts and students since 2004. They have over 200 corporate clients, 125 university clients, including Wharton, which is the university or graduate school I'm attending right now for my MBA. They've taught over 300,000 people. And right now, what they kind of focus a lot on are self-study online courses. And you can see if you go into their courses, they have everything from premium package. Their premium package and most popular is like financial modeling. They also have a basic version. They have tons of different topics of modeling. They also have like accounting, which I recommend if you're kind of like new to finance and all of that. Just a lot of stuff. And there's a discount you can use if you use the code rareliquid. And that will give you 20% off. And what I would recommend if you want to learn more about modeling, after this video, you're interested in learning more, their financial and valuation modeling certification program. Currently, they taught over 100,000 students, so a lot of like social proof there already. It's $400, which is an investment. It's not super cheap, but I think if you really want to learn about these kind of topics, which I'll show you here, financial statement modeling, DCF modeling, M&A modeling, trading comps, transaction comps, LBO modeling, basically everything I learned when I was at JP Morgan, then Wall Street Prep, this course will really thoroughly teach you about like each of those topics. And I also do recommend this accounting crash course if you haven't really, if you're new to finance, because accounting is really the foundation for everything, as you'll see kind of in the later on in this video. And the last thing I just wanted to briefly mention is that one of my former colleagues at JP Morgan, we were both in the healthcare group, and he actually works at Wall Street Prep now. So that kind of speaks to me, at least, of the kind of focus on talent that Wall Street Prep has, because I can assure you his salary is not cheap as a former banker. Okay, so with that said, let's go back into our tutorial. So the first thing we want to do is go over key accounting concepts. So these are really the main figures that you're going to need to know in order to understand what trading comps are. And if you're new to trading comps and accounting or finance in general, this might be a little intimidating, but I can assure you that these will make sense over time throughout this entire video. So first thing is equity value. And this you may know also as market capitalization. And this is simply your share price times your number of shares. So if you have a $10 share price and 10 shares, then that's $100 in equity value. Then you have enterprise value, which is your equity value plus preferred stock, plus debt, plus non-controlling interest minus cash. And I'm going to simplify this for you guys a little bit later, but just going over each of these, preferred stock is a different class of equity that's different from your normal equity and your equity value. So these normal shares are things that you and I could buy on TD Ameritrade, Charles Schwab, Robinhood. We could buy shares of Apple or Tesla. Preferred stock is usually more for like private investors, institutional investors who have like a different class of stock, which is called preferred stock. Often they have some kind of special condition to them, like paying dividends or being higher up on the cap table, so that if a company goes bankrupt, then they get paid before the normal equity holders. And then there's debt, which is, I think, pretty self-explanatory. Non-controlling interest is when you own more than 51% of a company but less than 100%, and that remaining amount is your non-controlling interest. So let's say I own 80% of a company. I have 20% of the company that someone else owns, right? And so you would want to add that 20% into here. I know that might be a little bit confusing, but don't worry about too much about preferred stock and non-controlling interest when you're thinking about enterprise value, because those are not super common amongst most companies. I say like 90% of companies don't have either of those, but 100% of companies will have cash. I don't know exactly what percent, but a lot will have debt. So those are what I would focus on. And what you do with trading comps, and this is kind of getting ahead of what the actual, we're kind of getting ahead of ourselves, but what you do is you either get your equity value or enterprise value in the numerator, and then you divide by your revenue, gross profit, EBITDA, EBIT, or net income, depending on what trading multiple you want to look at. And so that's why I just organized this slide like this. This will all make sense. If this is all new to you, it will all make sense for you in a matter of minutes. But I organized these in by descending order on the income statement. So EBITDA is actually not on the income statement, but it would start off with revenue. Then you subtract out your cost of goods sold. Then you get your gross profit. And then EBITDA is your earnings before interest and taxes plus your D&A, which is your depreciation and amortization. And that is higher because this is a larger number than your EBIT. And then that gets you to your net income, right? So going into enterprise value a little bit, I wanted to provide you guys this graphic to show you guys what all this really means, right? Because enterprise value is your equity value plus your net debt, which is your debt minus cash, plus preferred stock, plus non-controlling interest. And I thought this kind of graphic would be helpful because you can just think of each of these on the right here as different types of owners in the overall company. And so you have your equity holders, you have your debt holders, you have your preferred stock holders, and then you have non-controlling interest holders in the overall company that you do own, like the 100% of everything. But here's the portion that you don't own. So hopefully this graphic is a little bit helpful. And as I mentioned, I wanted to simplify things a bit, right? So if you're new to everything, just think about enterprise value as equity value plus debt minus cash. And that's not, when you get more advanced, you don't want to just think about it like that, but for starting off purposes, think about it in that way. And let's go into what each of these on the denominator means. So revenue equals products and services sold, should be pretty self-explanatory. Gross profit, revenue minus cost of goods sold. EBIT is earnings before interest and taxes, also known as your operating income. And I did this first because EBITDA has EBIT as part of it. So EBITDA is your EBIT plus depreciation and amortization. And then net income is your EBIT minus interest minus taxes. It's at the very bottom of your income statement. And overall, when you're looking at trading comps, again, we're going a little bit ahead of ourselves, but your equity value, you divide by your net income to get your PE multiple. So price per share divided by earnings per share multiple. And then for everything else that you see in blue, you want to do enterprise value divided by revenue, gross profit, EBITDA, and EBIT. And to explain this, the reason you want to do equity value divided by net income is because for your net income, you've subtracted out your interest payment, which is what you pay to your debt holders, right? And so what's remaining with net income is only attributable to your equity value or your equity holders because you've already paid out the amount that you need to pay to debt holders, right? So this net income is only available to equity holders. But in contrast, and this can kind of help explain what I mean if that was confusing, enterprise value has your equity value plus your preferred stock debt, non-controlling, and you subtract cash, right? And so this includes your debt, while this excludes, right? You don't see anything that has debt in here, right? Enterprise value includes your debt. And so all of this, revenue, gross profit, EBITDA, EBIT, this can be paid off to your debt holders. That's kind of how you want to think about it intuitively. And the reason this can be paid off to your debt holders, in a sense, is because you haven't paid your interest payment yet, right? And so because this is more about trading comps, I'll kind of leave it at that. Maybe if this was confusing, let me know in the comments and I can provide more detail. So let's now go into what are trading comps. So the interview answer that you would maybe want to give at an investment banking interview is that trading comparables, also known as comparable companies analysis, is a relative valuation methodology through which you compare the financial metrics across a set of companies similar to the one you're analyzing to determine your target company's valuation. So there are a few key terms that are pretty important that I wanted to just highlight here. So comparable companies, right? That kind of gives away what this entire valuation methodology is all about. You're comparing companies against each other. It's a relative valuation methodology in contrast to an intrinsic valuation methodology, which would be like a discounted cash flow, which I do have a tutorial in the description down below, by the way, if you're interested in learning more about the DCF. And as I mentioned before, you're comparing the financial metrics across a set of similar companies. So you don't want to be comparing, let's say, like Apple and JP Morgan, right? You don't want to be comparing like a tech company and a bank. You want to be comparing tech companies with each other and banks with each other. And then that's all to determine your target company's valuation. So you're looking at all the comparable companies' financial metrics in order to apply them to your own target company that you want to value. So common financial metrics you can kind of see here are operational metrics like your revenue growth, EBIT and EBITDA margins, profit margin. And then trading multiples that are pretty common are your revenue multiple, EBIT and EBITDA multiples, and PE multiples. And this is eventually what is kind of similar to what we're going to build to. And this is what trading comps tend to look like on the back end or like inside an Excel of like an investment banker's Excel. I'll show you what this all looks like soon. One thing that I did want to note though is that you can kind of look at whatever operational metrics you want. You can kind of create whatever trading multiples you want. So for example, if you have a company that's pre-revenue and so you don't have revenue metrics or EBITDA and profit margin, all of that are all negative because you don't have revenue and you're only spending cash, so you're at a negative value. You could look at something like enterprise value divided by your employee number of employees, or what they used to do for a lot of companies that were in the .com phase and only had like a website. It'd be like enterprise value or like value of the private company and divide by the number of page clicks. You can do anything like that to just come up with some kind of multiple, look at what your comparable companies have for their multiples, and then apply it to your own. So going into the 5 steps, we're going to first create a set of similar peers. Then second, gather the relevant financial information. Third, compare the financial figures of your target company versus peers. Fourth, determine your target company's implied valuation. And lastly, calculate your implied share price. And so this is where the Excel, which let me pull up right now, is going to come in handy. So overall, this is it's gonna be what we fill in. I'm going to zoom in a bit so that you guys all can see everything on YouTube. And we're going to be looking at Apple today. So these are the 5 steps that I just went through. And so the first step is to create a set of similar peers. Commonalities you want to look for are the size. So market cap, you don't want to be comparing Apple to something like Datadog or Cloudflare, which are companies that are much, much smaller. You also want to look at revenue size. So like Apple and Microsoft would make sense because they're kind of similar. If you also want to dig deeper into things, you could look at employees and assets. Usually market cap is good enough. Then you want to also look at industry. You want companies in a similar industry, as I mentioned before. Ideally, similar geography. You don't want to be comparing like the US and China if you don't have to. Then growth rates are ideally similar, margins, profitability. These two, I would say, are a little bit less. It's okay if they're not as similar. I think the first 3 are a bit more important. So let's see what this looks like in Excel. So you can see we're going to be looking at Apple. I just kind of randomly chose, hey, let's choose 8 similar companies. And we have like a database that I have down here. And so our job is to pretty much go through these and then figure out which are the similar companies, right? So now this is kind of where things are a bit more of an art than a science. Like there's no exact 8 set of peers that we have to use for Apple, right? If you really, and this this is like a little bit more since Apple and these are the largest we're gonna have to use the largest companies in the world. That's where it's like a little bit more there'd be more commonality with different bankers. But then if you're looking at a really small company, which I don't think we necessarily have here. Oh, maybe like Paycom, right? This is a really small company that's worth I think $18 billion. And for a small company, you would have a lot of variety. But for Apple, since it's one of the largest companies in the world, we're probably going to have to use some of like the largest. Since Apple is the largest company, we're going to have to use a lot of the largest companies. So let's pull up here. Let me actually hide these rows for now so we can see everything. Okay, so we're gonna have to use Microsoft because obviously one of the largest companies. Let me show you guys one thing. So Shift spacebar, and then Control Shift, and then the down arrow key will allow you to highlight all of the things I just highlighted, and then we can go to Filter, and this way we can see what the largest companies are, since Apple is the largest company. All right, Alt HSF clears the filters. So we're going to want Microsoft. We are going to want Google. We're going to want Amazon. Tesla's not super relevant, so let's leave it out for now. Facebook is one of the largest companies in the world. There's NVIDIA, which since they are both hardware, let's just use NVIDIA. By the way, all of the numbers and stuff I'm showing you today, not necessarily going to be exactly you should not base what we do today and like invest in Apple based on what we do here. This is really all for learning purposes. So, okay, so I added those 6 companies so far. Let's try to find 2 more. So Samsung is a pretty relevant company since they compete on smartphones a lot. And then let's go with Adobe since that's another big tech company. Okay, so we have chosen our set of tiers. They're all kind of tech related. The thing I wanted to mention about trading comps, which I didn't earlier, is that this is a very imperfect analysis. Now, Apple versus all of these companies are obviously very, very different, right? But this is why it's a relative valuation rather than an intrinsic one, is because you're kind of looking at similar companies and trying to get to a valuation. But of course, these companies are so different from one another. But you do get like an overall view of what valuation should look like, which you'll kind of see when we go through like calculating implied share price and everything. So, okay, we've chosen our tiers. Next, step 2 is to gather the relevant financial information. So important information to collect: share price, market cap, cash, debt, enterprise value, revenue, EBIT, EBITDA, net income. These are typically what you'll need for most companies that have some kind of revenue and are public. And resources you can use to get this information: historical information you can get from bamsec.com, Edgar. If you want future estimates that people use kind of in banking and in finance in general, there's Bloomberg, CapIQ, FactSet, but they're a bit harder to get. Usually you have to have like a company, like a research company, or you have to be a bank or something, or be an investor. And they're usually at least $1,000 a month. Yahoo and Google Finance, Wallmine, Ticker. These, I'm actually not sure if Yahoo, Google Finance provide estimates, but they might. Wallmine and Ticker, these are other companies. These 2 companies are ones that I have seen before, but haven't really used a lot myself. But they do offer an ability to kind of search through a lot of companies and then kind of download a bunch of information all at once. And then for rareliquid, I actually also send out trading comps every month. Every week. Let me kind of show you what it looks like. So this is on my Patreon, which is linked to down in the description below. But you can see here there are a bunch of trading comps for big tech, China, fintech, hardware, banks, asset managers, etc. And then I also have it for cybersecurity, data analytics, e-commerce, etc. A bunch of stuff here. I send that out every week in case you are interested in that. But now let's go into our Excel and kind of gather the relevant financial information. So in here, all the information is down here, right? And so we're going to just use a very simple VLOOKUP in order to get all this information. So usually, you gather all the information, but for in our purposes, kind of already gathered everything. So what we're going to do is VLOOKUP and then look up our Apple value. So equals VLOOKUP, use and then open parentheses, use the left arrow key to get to Apple. And then the table array is here. So using the down arrow key to get to here, then Control Shift right arrow button a few times, and then keeping Control Shift and then the down arrow key. And press F4 to lock everything. And then we want to be looking up the figure down here. Sorry, my computer is lagging a little bit. F2 a few times in order to get to the row anchored, and then 0. And then that gets us to our, oops, that gets us that makes our VLOOKUP work. If you just copy and paste this down, then you should be able to get to what I just did right here. Okay, so when I copy pasted, okay, this isn't really like an Excel tutorial, but I do want to make something clear. When you do copy paste down, it copies like the entire formatting. So what I did to undo the formatting is Control Shift and then down arrow key and then Alt HBN. I do also have a Excel tutorial video in the description you can check out. But now that we've done that, we can actually copy paste this across in order to get our figures. So what I'm going to do here for Apple is Control C in cell C11. Then I'm going to press the Shift arrow key and press the right arrow button until I get to my net income. Let go of my hands and then press Alt ESF. So we're copying the formula. And that did not work. Let's see why. Oh, sorry. This first formula over here, you actually want to anchor your column B. So press the F4 button 3 times to get your column anchored. And then copy paste this across again. So Alt ESF, this should work now. Okay, so these need to be reformatted. So what I'm going to do is Control copy, Control EST. So then this gets us to all of our figures that we have in our database down below. So I do want to go over that one more time because I know that might have been kind of fast for a lot of you guys. So what we did here is equal VLOOKUP, open parentheses, then press the left arrow key, then press the F4 button 3 times, then press comma, then use the down arrow key to go to your data here, and starting with Apple, press Control Shift and then the down arrow key and then the right arrow key a few times, then press F4 to anchor everything, then press 0, then press comma, then 0. Oops. Press comma and then go down to row 33 where these numbers are here to kind of indicate which column to look into. Press F4 2 times to anchor the row, press comma, 0, then close parentheses, and that'll get you what you need. And then what I want you to do is press Control Copy, and then go to the Microsoft kind of cell, and then press Control Shift down arrow key, Alt ESF. Then everything should work. And then getting our same formula, you want to copy paste this across, Alt ESF again, and we can delete that. So that gives us all the figures we need for Apple, and then we want to control this, copy this row, and then Alt ESF, and then you can just copy paste this down. Okay, so if you're kind of new to Excel, that might have been a little fast, but by the way, all these shortcuts that I'm using are pretty much only for the PC laptops, but if you do have a Mac, you should be able to still do a lot of this stuff. Okay, so we gathered all of the relevant financial information, right? And the next thing that we need to do is compare the financial figures of, so we need to compare the financial figures of your target company versus your peers. And one thing that I forgot to kind of do here is actually figure out what are. So let me take a step back. We're actually still on step 2. We need to gather all our financial information and then calculate our trading comps. So as you can see here, we have all of the figures, right? We have current price, share count, enterprise value, market cap, and then we have revenue, EBITDA, net income. And on the right side here, we need to calculate what our growth rates are, margins are, and then our trading multiples. So what we want to do here is equals, then get our revenue, and then divide by our previous year minus 1. That gets us to 5%. EBITDA margin is your EBITDA, then divided by the year that you're in. And then profit margin, similar thing, net income divided by the year that you're in. And then for trading multiples, we're going to skip Apple because this is a company that we need the multiples for. Well, actually, let's just do it anyway. So the figure, or what you're going to need to do is EV divided by revenue, which is your enterprise value divided by revenue, so 2022. And then if we actually go into our cell here, so press F2 and then the left arrow key, and then anchor our column, then we can actually just copy paste this across. And you can see that when I double check, you can see that it actually keeps it at the same column. That's what the anchoring does. Or I guess the better way is to look over here. You can see the F on both of these, right? So it's using the enterprise value to divide by the 2022 revenue and then the 2023 revenue. Then over here, we can actually just copy paste these two across too, because it'll get your enterprise value and divide by your EBITDA. So you can see here the cell F11 divided by L11. So let's just double check that. F11 divided by L11, which looks right. Okay, now for your PE multiple, that's your price per share divided by your earnings per share. It's also the same thing as your equity value divided by your net income. So equity market cap divided by your net income, which we went over earlier on. Oh, oops, we need to anchor the G in this one. So press the F4 button a few times, then we can copy paste this across. All right, so now we have the trading multiples, we have our margins and everything. So we can actually now just copy paste this down. So if we press Control Copy, so the way I did this is Control Shift, right arrow key 3 times, Control C, and then go to your Microsoft and Alt ESF. Right, that gives us the information we need. I'm going to actually delete the conditional formatting that we have here. Okay, so now we can just copy paste this down. And now we have all the figures that we need for our trading comps. So I know this is a lot of data and information. Let's kind of go into breaking all of this down and how to really make sense of it all. So step 3 is to compare the financial figures of your target company versus your peers. And typically, what would be an expensive company is something that a company that has low growth rates and low margins, but high multiples. So let's say like 1% growth rate, 10% EBITDA margin, but it's trading at like a 30 times revenue multiple. That would be an example. Cheap would be high growth rate and high margins, but low multiples. And then something that you would normally expect is a low/high growth rate and low/high margin, and then a low/high multiple. So low growth rate, low margin, low multiple, high growth rate, high margin, high multiple. That's usually what you would expect. And to explain what multiples mean, basically what these numbers are really saying here is that for every $1 in revenue earned, the investors are willing to pay $6.5 in their $6.5, right? And so that's basically what this means. So, and every dollar in EBITDA earned, investors are willing to pay $19.7. And then for every $1 earned in net income, the company is willing to pay investors are willing to pay $24.7 in this particular example. Okay, so as I kind of discussed, we kind of need to now make sense of the data by looking at the financial figures for your target company versus your peers. One thing that people often do is they will get your median and mean and median. So for this formula, we're going to use average, open parentheses, control shift, up arrow key, close parentheses, 10%. And then for median, similarly, median, open parentheses, shift, control shift, up arrow key, close parentheses. And then let's copy paste this across. And then for these, you want to do your Alt ESF and copy the formulas instead of copying these, because instead of just control pasting, because this will make it a percentage. Okay, so all right, what we can do here to kind of make sense of a lot of this is you can see that our just to give you an example of how maybe I would look at something like this, right? One thing that's helpful is to do some conditional formatting. So I'm just going to show you what this looks like, but you don't necessarily have to do this yourself. I'm going to kind of do this real quickly. Okay, so if you look at, I created this like stoplight conditional formatting, right? Where green is good. So the higher that these figures are, the better. And then the lower that these figures are, the better. Because this means if they're lower, that it means that companies could potentially be more undervalued. But there usually is a good reason why investors are paying less. And it's usually because their margins may not be good enough, or their revenue growth isn't good enough, or as good as their peers. So for example, here for NVIDIA, right? You can see a lot of this is green. Companies growing quickly, their margins are good, but investors are paying they're paying a premium in order to invest in this company because these margins and figures are so good. And that's normally what you would expect. You would want to see you usually see high margins, high growth, and then expensive multiples. On the flip side, let's see something that kind of looks cheap. Facebook has decently high growth, and their margins are pretty strong, right? Like 45% EBITDA margins are strong, but their multiples are really low. So this is where you could argue that Facebook is pretty cheap on a multiples basis. And the reason that it's cheap right now, there's always a reason that things are cheap. Investors are not stupid, and they will look at these things very quickly and scoop up the investments that are cheap, right? But Facebook obviously has been having a lot of issues with its branding image, and then also making investments into the metaverse that may not necessarily play out. So that's why Facebook multiples are kind of like on the lower end. And then let's look at something. So what did we go through so far? We went through something that's kind of normal. So NVIDIA was high growth rates and margins, but high multiples. Something that was cheap, so high growth rates and low multiples. Something that's expensive is low growth rates, but high multiples. Not sure if we're going to necessarily have that here. Yeah, I don't think we necessarily have that. I guess you could kind of argue based on these peer sets that Apple has kind of low growth rate, and then margins are kind of decent, but not as high as some of its peers. But it's trading at higher EBITDA multiples than something like Microsoft, which has higher margins and higher growth. So then you can kind of make the argument maybe that Apple is expensive, but that really is probably also for good reason. So companies that are expensive or cheap or normal and trading at certain multiples, like they're usually for a good reason. But this is still a really good way to kind of figure out like what companies are trading at. So let's now go into the next step, which is determining your target company's implied valuation. So what we need to do here is to use the data to determine a multiple range that can be reasonably applied to your target company. So more specifically, you get the multiple times the financial metric for whatever multiple it is to calculate your target company's implied equity or enterprise value. So for example, if we have a 10 times revenue multiple, and then we have $10 million in revenue for our target company, our implied enterprise value is $100 million. So going into our Excel here, what we're going to do is look at our minimum, mean, median, and maximum trading multiples in order to get to our implied valuation. And so let me show you what we're going to do here. So we're going to press equals min, open parentheses, and then press the right arrow key. And then we're just going to be looking at our 2023 multiple here. So in order to look at our minimum here, we're going to press Control Shift and then the up arrow key, and then close parentheses. And that'll get to our minimum of the revenue multiples that we have there. And we'll do the same thing for EBITDA. So equals min, right arrow key. And then same thing for our PE multiple as well. And you can look at however many years you want, but for our purposes, we're just going to look at 2023. And then for mean, we actually calculated this already, right? So we can just link to our figure here. And same thing for our EBITDA. Same thing for our PE multiple. And because we know that the median is right below the mean, we can actually just paste this down. And then for our max, it's going to be similar to our min, where we do equals max, and then go to our cell here, or cells here. So that's equals max, open parentheses, right arrow key, and then going to our EBITDA column, Control Shift, right up arrow key, and close parentheses. And then same thing for our PE multiple. All right, so now we have the multiples here, and what we're going to need next is our financial metrics. And so what we're going to do is press equals and just link to our financial metric here for Apple. And then for EBITDA, do the same thing. For EPS, I just pulled kind of like a roughly ballpark of what Apple's EPS is, and we're going to need to use this for our calculation for our PE multiple. And these are all going to be the same, so we're just going to copy paste these. And by the way, the way that this looks right now is not necessarily what it would look like when I was in banking, but I just wanted to show you guys all the steps and calculations so you can kind of follow what all the numbers look like. So next thing to do is calculate our implied enterprise value, right? So in order to do that, we just simply get our revenue multiple and multiply by our revenue figure, right? And same thing for EBITDA. 3.2 times your EBITDA. So what this implies right now is that Apple, based on our minimum multiple based on our similar set of peers, is that Apple's valued at 390 billion, which is obviously too low. And then based on EBITDA, 430 billion. We multiply this down, you can see that based on our mean, Apple's worth 2.3 trillion, EBITDA 1.8 trillion. Based on our max, it's 4.8 trillion, and then 3 trillion, right? And so you can see that these numbers are super variable. Usually what my managing director would do in banking, he would look at the similar peers and he would create his own range. So oftentimes there are numbers you can kind of exclude. So for example, Amazon trades at a really, really high PE multiple, and we would probably want to exclude that in our analysis. And so we would literally probably zero these out. And then for Samsung, because it trades on the Korean stock exchange, there's a little bit of different rules. And so we would probably delete this as well. And so you can kind of see here how that changes everything. Well, actually, that was just for PE. We would have to delete all of these. Let's see here. You can see here now that that $300 billion that we had now has increased a lot, right? As well as our mean and median. So in a nutshell, that's pretty much what you would do. We would probably never look at our minimum, and we would probably set our own range of, if we look here, something like 13 times to something like 25 times or 31 times. And that's the range we would look at. So next up, let's look at our calculating our equity value, right? So we calculated our enterprise value based on our figures so far. We actually now need to calculate our equity values. So in order to do that, you get our revenue or enterprise value plus our cash minus our debt. And normally you would also subtract out non-controlling interest and preferred stock if you had any. And we can just copy paste this across in order to get to our figures. For our equity value for our net income, this will be a little bit of a different system or formula. So PE multiple is price per share divided by our earnings per share, right? And so in order to get to our equity value, we're going to need to multiply our PE multiple by our earnings per share. And that will get us to, so first, here, let me show you what it looks like. So we get our earnings per share multiplied, So we get our earnings per share multiplied by our shares. That first gets us to our earnings, right? This is our implied like net income in a sense. And then what we want to do is multiply this by our price per share. And that'll get us to our implied equity value for our based on our PE multiple. So PE multiple is a little bit more tricky, but you can kind of just like think of it as like a simple algebraic math problem. You have your price per share on the numerator, earnings per share on the denominator. To get ultimately to your price, which is your equity value, what you want to do is multiply your earnings per share times your number of shares, which gets us to your earnings, and then multiply that by your PE multiple, and that gets you to your price, essentially. So now we have our equity value here, right? And so now all we need to do is step number 5, which is calculating your implied share price. And so this usually has 2 methods, which we actually we jumped ahead and went through, which is getting your enterprise value and backing out to your equity value, which is your enterprise value minus debt plus cash equals your equity value. Get your equity value divided by shares to get your implied share price. For PE multiples, your equity value is what you end up at, and so you divide by your share count to get to your implied share price. So that's what we kind of did here. What we want to do here in this implied share price part is get our implied equity value. So equals our implied equity value here, divide by our number of shares, which is here. And we can just press F4 3 times to anchor the column. And that'll get us to our implied price per share. Let me format this correctly. And so if we copy paste this across, you can see all the different values, implied share prices for Apple based on our trading comps. Right, and so you can see a range based on our 2023 revenue, anywhere from $74 to $285. For our EBITDA, 63 to 194, and for our PE multiples, 45 to 110. And obviously, like these numbers are not what I want you to use to just say like, oh yeah, this is what Apple should trade at or anything like that. This is really just for educational purposes. And that's pretty much your trading comps. I hope, I know I went pretty quickly through some of these parts. And if you have any questions, definitely let me know down in the description, because I definitely want to, answer anything that was like a little bit confusing. Hopefully also, you could watch this video a few times if needed and go through some of the sections that were a little bit fast. And then once you go through the Excel, which is linked down in the description as a friendly reminder, then you'll be able to really get good at trading comps if you follow everything that I did on the Excel. So next up, advanced topics. Really quickly, just wanted to touch upon a few things I'll probably make videos about later. One thing that's really important is calculating your true fully diluted share count, which will include things like options, warrants, and convertibles. Then spreading cash and debt figures correctly. Right now, I kind of pulled the figures for you, but a lot of times things could get a little bit tricky there too. So you kind of have to dig into the actual financial statements in order to get your correct figures. Third one is kind of what I would consider the trickiest, which is incorporating M&A transactions not accounted for in the latest filings. So a lot of times companies will release their filings, let's say in January 2022, and then they made an acquisition in February 2022, right? And let's say right now is something like March. Then the M&A transaction won't actually be accounted for in the latest filing, so you have to actually include that to see what your company's valuation looks like today. So that's another kind of important thing. Pretty advanced, I would say. And then lastly, a premium to historical multiples analysis. So I'll show you what that looks like in this is something I sent to rareliquid Patreon members, which is also linked to down in the description. But over here, there's a section for premium or discount to historical multiples. So this is pretty simple, where you're just looking at historical multiples of what companies were trading at in the past compared to today's multiples, and then basically seeing if they're trading at a discount or a premium. Something I can also go into more in a future, more in-depth like trading comps video if people are interested. So that pretty much wraps up the video. Wanted to give a shout out again to our sponsor for today's video, Wall Street Prep, and definitely feel free to check out their courses if you are interested at all in learning more about valuation or how to model. Use my code rareliquid, you get 20% off. You'll see it in red off of any course, and usually the one that most people over like 100,000 students so far have signed up for is the financial and valuation modeling program. Also, if you're kind of new to everything and you want a more basic fundamental understanding of finance, definitely recommend their accounting crash course first. And with that said, hope this video was helpful to all of you. Hope to catch you in the next one. Thanks so much all, and peace out.